You're listening to another episode of the Young Investors Podcast, so sit back and relax as myself, Brandon, and my buddy Hamish discuss the latest in the world of finance and stock market investing. Now, a quick reminder before we get into the podcast is that nothing in this podcast should be taken on as personal financial advice. If you're ever unsure about your finances or investing and you need some help, make sure you reach out to a qualified financial advisor. But with all that said, let's get into another episode of the Young Investors Podcast.
Welcome back, everyone, and a very congratulations to Brandon for his rebranding that happened
thank you.
This week.
A very congratulations.
Good. A very
Thank you.
wasn't sure where I was going with that, but I think it looks good.
I love it when you just have no idea. Like, I get into those situations all the time where you just like start saying a sentence and then you're like, hang on, that's not where I wanted that sentence to go.
Yeah, you know what my problem is? Because when that happens when I'm making a video, I just stop.
You stop. Yeah, that's the thing.
I just stop and I do it again. Whereas with the podcast, now I feel like we can
pressure.
stop. We can stop, but it's much better if we just kind of let it flow, I think.
Yeah,
so
exactly.
It's a little bit more pressure, all right?
It is.
So
no, it's definitely.
Go easy on me.
I've definitely felt that. That's one of the reasons that I was a little bit hesitant to even do a podcast, because even though it's not live, it kind of feels like it is, you know? You should watch me when I make a video, though. Like, I can't string two sentences together some days. It's ridiculous.
Oh, yeah. It's the difference between recording a podcast and a video. The podcast, we record even on a worst day, it'll be maybe 2 or 3 minutes more than the actual, what is actually edited. But a video, I'll do a 10-minute video and it'll be 30, 40 minutes of recording, just saying the same sentence over and over again. Hey guys and welcome back.
Yeah. No, I think it's just because there's that visual element. Like, we know that when we're podcasting, it's kind of like we're just on the phone in a way, because there's no camera pointed at our face, so it makes it a bit easier.
Yeah, true.
Yeah. Anyway, what do we got to talk about today? We got more earnings season.
Yeah, we got a couple of earnings.
Yeah, a couple companies. The big dogs are all going to be next week: Facebook, Google, Apple, and so on. We've got, what do we got today? We've got Boeing, we got Starbucks, Visa. I'll be interested to hear about Visa. That's one that you've been educating me about recently. Sounds like a crazy business, but we might get into more of that later. We've also got a couple of kind of economic things to talk about that have come out recently for Australia. So it should actually be a pretty jam-packed podcast, I would imagine. We've got lots of Q&A questions to get through as well, so hopefully we can get to some of them. Yeah.
Should we get to our sponsor?
We shall. Yes, let's do it.
All right. So today's episode is sponsored by Sharesight.
Is it?
Yeah, it is actually.
Oh, okay.
So Sharesight is an application that you can use to track the performance of your stock portfolio. And it's fantastic for keeping track of your capital gains, dividends. If you have dividend reinvestment plans, then it will do all of those calculations for you. Currency gains, if you buy shares internationally or you hold foreign currencies. And then the main reason why I use it is when it comes to tax time. So Sharesight generates up to 10 different reports that can be used at tax time to easily work out your capital gains, dividend income, and more. And you can try Sharesight for free by heading over to sharesight.com/young investors. That's site spelled SIGHT, sharesight.com/young investors. And if you use that link, you can also get 4 months off, 4 months free when you sign up to a yearly subscription. So go check it out. There's also a free plan that you can try for as long as you want. So go check it out if you're interested.
Yeah, definitely check it out. Thanks to Sharesight, as always, for sponsoring. And let's get stuck into it. So I wanted to start out. I've got this news story. Did you know that have you seen that Australia is now in deflation?
Yeah, it's crazy, right?
How crazy is that?
Something we certainly haven't seen in our lifetime.
Yeah, it's... I wouldn't even know when the last deflationary period was in Australia. But anyway, sorry, what were you going to say?
I was just going to say, I just looked it up just before because I didn't know either. It was 22 years ago.
22 years ago. So
yes,
there you go.
Whatever
so
that is,
I would
1998.
I would have been alive.
Actually, yeah, you would have been alive. I would have been
maybe alive.
Born in the process.
In the process of being alive. I love it.
I was being formed.
Anyway. So this news story reads, so Australia's Consumer Price Index, or CPI, fell 1.9% in in the June 2020 quarter, making it the biggest plunge in the history of the measurement. So new data from the ABS shows the dip was the largest quarterly fall in the 72-year history of tracking the CPI. The CPI is a measure of retail prices of what the ABS calls a constant basket of goods and services for Australian households. So according to the ABS, the annual inflation rate was a negative 0.3% in the 12 months to June 2020, meaning Australia is officially in deflation for the third time since 1949. So there you go.
Wow. Yeah. So the consumer price index, so that's kind of the measure of inflation or deflation over time, I guess. And it kind of represents this basket of common goods that people would need. And what does it mean when we're in deflation?
Yeah, it's a bit of a weird one. I'm certainly no expert, but from just doing some basic research, so deflation doesn't necessarily mean it's going to be it's not necessarily a bad thing, because if you have just a little bit of deflation, that can be fine, because essentially it means that the general basket of goods gets a little bit cheaper, and if say the TV goes from 25% off to 40 or 50% off, then that can actually spur some people to then go and buy those goods or services, and then that puts money back into the economy. So if you have a little bit of deflation, just makes prices a little bit cheaper, that can sometimes just be the tipping point, and people don't expect that prices are going to continue to get cheaper, so they just buy. The problem is when deflation happens too fast, because then shoppers essentially just stop buying stuff altogether, because they feel as though they just hold on to their cash because things are going to get even better and better. Like sales are going to keep getting better and better. And, that means that, inventory starts clogging up warehouses, manufacturing lines slow down, corporate profits fall. Once corporate profits fall, then obviously people get laid off, people get pushed out of work, unemployment rises. And essentially when unemployment rises, then even less people are inclined to spend. So that's where it's a bit of a slippery slope and a bit of a spiral, where if you have a deflation too fast, it can actually make the problem even worse, because even more people are less likely to put money into the economy, which should stimulate it. So that's kind of, I think is that how you would kind of explain deflation?
Yeah, exactly. And I guess it also it's important to note that when there's negative 0.3% inflation, it doesn't mean that, everything, now that when I go and buy everything, it's going to be 0.3% cheaper. It's going to be concentrated in certain things that make up that basket most of the time. There will be something that falls substantially. Yeah, exactly. That drives that down. And in this circumstance, there was a couple of major things that drove this deflation. So childcare costs were down 95% due to government incentives. So that's an interesting point. So that kind of drove the deflation, but it's been driven down because government is coming in and helping out in that area. Yeah. We also had petrol, which was down 19.3%. I guess that makes sense. Yeah. So we had a substantial drop in the oil prices over the past year. They've actually gone back up a little bit in where I'm living at the moment. Definitely. Has that been the case for you as well?
Yeah, definitely. Yep.
Yeah, there were. I think we were at $1.80 for a liter, and then it went all the way down to about $1. Now it's at maybe $1.30 or $1.40 or something.
Holy smokes, that's crazy. Yeah, that sounds about right. I think we're at like $1.30. I don't know. I don't really buy petrol that often.
Yeah, I don't either.
Yeah, but so what do we got? Childcare costs, petrol, and preschool costs. So I guess that's kind of like childcare. So preschool costs were down 16.2%. So they were the three biggest contributors to Australia's deflation. Very interesting. I mean, I certainly haven't really seen a deflationary environment, I suppose. So, watch this space and we'll see what happens, because I really don't know what to expect, because I haven't seen it before.
Yeah, I mean, with the amount of stimulus and money printing that's going into the economy, I couldn't imagine that there would be. I mean, there's quite a lot of upward pressure on on the inflationary side.
Yeah, that makes
So
sense.
You would imagine that if there is continued government spending, giving money to people so that they don't, if they can't work their job or while they're looking for a job, then you would think that would contribute to reducing the deflation and providing some inflation. But I guess we'll kind of see how that plays out.
Yeah, see how that plays out. So there you go. Australia is in deflation. Who would have thought? Who would have thunk it? All right, moving on. The next thing that just caught my eye that I thought maybe we should talk about is that there was this Productivity Commission report that came out. I don't know if you saw this floating around. It didn't seem to be heavily reported on. But young people, the headline is basically that young people in Australia have faced a lost decade of income while older workers have seen wages increase at their expense. That's according to a new Productivity Commission report. Why did young people's income decline? So essentially what I'm looking at this chart, the year 2001 to 2008, and in all age categories, incomes went up, between 2 and 4%. Older Australians, their incomes did rise at more than 4%. Younger Australians rose more at the 2%. However, if we then look at the years 2008 through to 2018, which seems weird. It's like that's still quite out of date. But anyway, we'll run with it. Then you can see that everyone kind of grew less, except when you have a look at the younger people, so 15 to 24s and 25 to 34s, they actually had a reduction in their income. So they actually had a negative 0.5, -1, -1.5% annual reduction in their incomes over those 10 years. So that's it's pretty interesting looking at that chart. We've gone from this environment where everyone's wages are everyone's incomes are going up to now young people actually, their incomes over the past 10 years have reduced each year, whereas older Australians have still maintained a positive income growth.
Yeah, and it's quite a wide gap. It's not, included in the people who have seen income go down, it's ages 15 to 34.
Yeah.
So it's not just, I guess, teenagers or something. I guess whenever I hear the term young people, I'm thinking like 15 to 24, right? Or something like that. But up until 34, that's quite a wide gap. The other thing that's interesting to me is that overall wage growth has just been so much lower than it has historically. And that's been a real big, I guess, point of contention, particularly in politics, I guess, for Australians, is the fact that we've had a combination of really low wage growth in combination with really high housing costs and costs of living. So, I don't know what drives that decline in young people's income.
Yeah, I'm not too sure either. We need to get like an economist on the podcast and pick their brains because, all these kind of macro figures, like we talk about them and stuff, but I don't really have that really deep, understanding of, economics. I suppose that's because I didn't study it. But it would be interesting. We should try and get, I don't know, some sort of economist or something on the podcast. I reckon that'd be cool. Pick their brain a bit.
Yeah, we should. So if you're an economist, send us an email.
Yeah, exactly right. But they're the first two news stories I just wanted to kind of get out the way at the start. Should we go through maybe a couple of earnings releases now?
Yeah. So we'll start off with Starbucks because this is probably the one I've got the least to say on.
Yeah.
But Starbucks reported, obviously a huge company, and a lot of people have been following it. So revenue came in at $4.2 billion, which was down 38%.
Wow.
From the same period last year. So a substantial drop in Starbucks' revenue, and that was driven mostly by comparable store sales, which declined by 41%. So that's basically a measure of how much sales the existing Starbucks stores are generating in terms of how many people are coming through the door and how much are they spending. And most of that decline was driven by traffic. So they actually saw, in terms of the average price, the average order value, that actually went up during the period. But the traffic was down substantially. And that kind of makes sense, I guess. The small number of people who still want to go to Starbucks, they're going less frequently and they're more likely to buy in bulk, I guess. Maybe there's one person out of the family that goes and gets all of the coffees instead of everyone going on their way to work.
And I imagine a lot of Starbucks would have been shut for a fair for a fair while in the last quarter. I don't know. I imagine I don't really know this company very well at all, but I imagine most of their stores would still be in America, even though they're quite a global kind of company.
Yeah. I mean, they certainly in the first month of this period, they did see a substantial amount of closures, or at least limited operations.
Yeah, right. Okay.
In China, they have a lot of business in China, and a lot of that has been completely reopened. So,
cool.
In many ways, they're still operating at a limited capacity, social distancing and many other rules restricting people from going in and sitting at a Starbucks, for example.
Yeah, right.
That's very popular. I'm sure it's popular everywhere, but particularly from what I've seen, people going in and just working at Starbucks, just sitting down at a desk and working. I know I've done that a few times just to sort of change up the environment, but that's certainly not possible at the moment. During the period, they opened net 130 new stores. So net of any stores that were completely closed down, they opened another 130. So they continued to open a huge amount of stores, bringing their total to 32,180 stores.
Wow, that's a lot of Starbucks stores. That's crazy. I don't think we haven't got Starbucks here in Canberra.
Right, really?
I don't think, that's why I'm just like, I'm so out of the loop with Starbucks. Like I don't encounter it at all. There's just none here.
A while ago, there was a lot in Melbourne a long time ago, and then they closed all of them down. And there's a really great CNBC short movie kind of thing, 10-minute clip explaining how Starbucks failed to enter into Australia.
Right.
It's really interesting if you want to go check that out.
Yeah.
But essentially, more recently, they've been coming back slowly. I've started to see a few more. There's a few more popping up. Around in Australia. But it's definitely not as popular as in, say, the United States, for example, where you walk every single corner of every single block, there seems to be a Starbucks store. Yeah, so of those stores, one thing I thought was interesting was they had 51% company owned and 49% franchised. So they've been going through this process that McDonald's also went through, which is they wanted to transition as many stores as possible to being franchised to reduce the expenses just being taken on by the company. Easier to manage. Yeah, exactly. They just collect a royalty, and that's pretty much all they need to do. So they've been going through that process, now 50% franchised. They took a loss during the quarter of $678 million, which was down from a profit of $1.4 billion in the same period. So one thing that we'll talk about, we can sort of juxtapose this between the Visa report that we'll talk about is a 38% drop in revenue for Starbucks causes a huge loss on the bottom line. Whereas we'll look at Visa and they even saw a substantial drop in their revenues. But because Visa just has such great margins, you'll see that they still have ridiculous profit margins, and we'll get to that. But for any business that's kind of capital intensive, physical products, physical stores, anything like that, particularly retail or restaurant companies or like Starbucks, and any kind of dip in revenue is probably going to mean that the company starts losing money.
Yeah, that makes sense. It's just, again, it's just like compare the business models, I guess. That's what we've been finding throughout the coronavirus is all of these companies with these really high, fixed costs, or they're manufacturing things at lower margins. Their margins are very high. They just get crushed. Like you take a hit, even a minor hit to your revenue, and that just cripples your bottom line. Whereas, we look at the online-based businesses, like the Facebooks or the Googles or whatever, and they still take these hits in their revenue, but they're still able to hold up so well. Like, bottom line is still fantastic. So I think one of the big lessons out of the coronavirus has been, when you're an investor, really pay attention to the business model, really understand how how your company is set up and how your company kind of makes money. And, does it take a lot of money to run that business, or is it a fairly low cost business? I think that's one of the big learnings that I've taken out of this time, is just how incredibly powerful it is to have a business that doesn't really take much money to run, I suppose.
Yeah. And I mean, Starbucks in terms of retail, like places with physical stores and selling food and beverage, I mean, they have good margins. They have a 20% profit margin typically, but then they have a drop in revenue of 38%, which is obviously very unusual. I'm not saying that this is something that's going to happen every year or anything like that, but that drop, 38%, resulted in a negative 16% margin. So most of their costs didn't really change at all. It was just the fact that revenue dropped and their profit margin was just completely eradicated. And that's completely different to a business that will, as I said, Visa, that we'll talk about in just a little bit. The other thing I wanted to mention quickly from this report was management said that they expect their stores to resume normal growth in Q1 and Q2 of 2021. So they're expecting it to be quite a while before they get back to normal growth. And the amazing thing to me is that management is still providing guidance for the next 12 to 18 months, which is hilarious because most companies at this point have gone, okay, we won't do guidance. We get it. We can't guide forward in these uncertain times. And I just wanted to just show the guidance that Starbucks has given. So 6 months ago, their guidance for earnings per share, and this is while they had a ton of stores in China and they were aware of the coronavirus. They mentioned the coronavirus in the report 6 months ago.
Yep.
And their guidance for earnings per share was about $2.85 for the year for 2020. This year so far in Q1 to 3, so the first 3 quarters, they're at 44 cents. So
they got a big task.
they got a long way to go.
We are not altering our guidance. Yeah. We anticipate. It's just like, Q4 and Starbucks just comes out with like earnings per share of like $50 or something.
Yeah, and I mean, they've adjusted their guidance based on what's happened to be more realistic that they can actually achieve it. But the thing is, like after that happens, after that 6 month period, surely you think, okay, what's to say the next 6 months isn't as equally uncertain?
Yeah.
On the upside or the downside. Like how could you possibly know? And I don't know. It just seems insane to me that you would continue to provide guidance, but that's
I like
the
the companies that have just been saying, like being real honest about it. Where they can reasonably predict things, they are trying to inform shareholders. So that's, if they're able to reasonably predict their earnings will be so-and-so for the year, then they say that, but they always say, look, obviously we are very unsure about this. We could hit this, we could miss it. Who knows what will happen in the future. And, fair enough that a lot of companies are saying, to be honest, this is so strange, this situation, that we honestly just can't give you guidance. So I think that's kind of interesting. Instead, some companies have not given financial guidance, I suppose, but have tried to provide more like operational guidance, like saying, this is what we're aiming to do in the next quarter, as opposed to we want to try and produce this amount of revenue, this earnings per share, whatever. They're just saying, look, we're trying to do this operationally. We're trying to open these stores up. We're trying to get, improved, comparable store sales in, United States or something like that, as, blah, 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 and so on and so forth. So I think it is definitely fair enough that companies are not providing guidance, but I still like it when they're trying to still inform shareholders as well as they possibly can, I suppose.
Yeah, I mean, it just makes more sense, even when times are fairly certain where things seem to be going, normally. It just makes more sense to provide operational guidance rather than financial, because the financial side of things are just so uncertain.
Yeah, no, that's true.
Eventually, you have a management team that said, okay, we've given guidance of $2.80 per share and we're at $2.60. How can we get into the guidance? Oh, we can just buy back stock. And even if it's a terrible idea to buy back stock, we can push the EPS into this range and then we're right.
Yeah.
And it's like,
that's true. That's pretty
real
dumb.
long-term investors don't care if you're outside, or they don't even care about the guidance. As long as you're on track and you're doing things operationally that strengthen the business long-term.
Yeah.
I think it just incentivizes bad decisions, particularly for earnings per share. That's the one that can be really influenced by management. If they just decide we're just going to take on some debt, buy back some stock, and push earnings per share into this range. I'll get my compensation of $10 million this year.
That's it.
And it's
No, you're so right. You're so right. EPS can just get skewed like nothing else. And it's so true what you're saying about the payment plans and compensation and whatever. Like, please don't tie your CEO compensation plan to earnings per share. If your CEO is getting paid based on earnings per share, there and this is a yearly compensation thing, then you as a shareholder, you're screwed.
Yeah, and I mean, it doesn't necessarily mean that it's going to end up bad for that company. It's just that it's an incentive. It's there. Like, they have the lever to take on debt and repurchase stock to make themselves more money. It's like you're giving them the button to press to screw up the company.
Yeah, essentially.
Like, just don't give them the button.
I mean, you just think about it. I mean, you can just sit back and, listener or Hamish, I'll give you $3 million this year if you just take on a little bit of debt and you just buy back some of your stock. I will give you personally $3 million. That's going to sweeten your retirement a lot. And all you have to do is just tweak a couple of things with this company. If the company goes bankrupt, that doesn't really matter.
Yeah, I mean, you're not going to be here in You're not going to be here in 8 years.
Yeah, exactly. Yeah. It's just like, the company, you can resign, you can go on, you can work somewhere else, be a CEO somewhere else, but I'll give you $3 million if you tweak these couple little things in the business. It's like, man, I mean, a lot of people would cave to that, and a lot of people do cave to that, and that's where we see really bad management. So please just don't tie your compensation plan to earnings per share. Anyway.
What have we got next? We were talking about Boeing?
Let's keep talking. Let's talk about Visa, because you were just talking about that before. Yeah. So I said we'd make sort of a bit of a comparison between what happens when Starbucks, which is a relatively low profit margin company, when they see a drop in revenue and they start losing money compared to a Visa. So in terms of their top line, first of all, so net revenue came in at $4.8 billion, which was down 17% year over year. So basically, they generate revenue in three ways. One is services revenue, and that's dependent on the volume of payments, so the dollar amount of transactions in domestic countries. So US people paying US people, or Australian people paying Australian people. And then they have data processing revenue, which again applies to domestic transactions, but is the number of transactions. And then they have international revenue, which is cross-border transactions. And it was cross-border transactions which drove a substantial amount of this decline. That came in at $1.1 billion and was down 44% year over year. And that was also on a decline in the total amount of payments done cross-border of negative 37%. And I mean, this kind of makes sense. Basically, this has been hurt by the travel bans. So that basically puts a limit on foreign transactions. So obviously, even though there's travel bans, people can still buy products online. So they can still do online international transactions or foreign transactions. But there's no sort of, I guess, for an example, the Australian Visa card holder spending money in Europe, actually physically going to Europe and using their Australian Visa card. And that is also an international transaction because it's going from the Australian bank to the European Merchants Bank. So that was where most of the decline came. And I actually didn't think about this before when I've looked at Visa previously. I guess in my head I just imagined, international revenue won't be hurt because people still buy things online. But I never actually thought about people traveling and how much money is involved in people traveling to other countries. A lot of money in tourism, I guess. So yeah.
Yeah. The other thing to mention is that so for their services revenue, it's actually done based on the previous quarter's payments volume. So they kind of add up the payments from the last 3 months and then they charge the bank in the next 3 months, if that makes sense.
Okay. Yeah.
So we can actually get a bit of a forward look into the next quarter for that segment alone. We can't do it for the other segments, but just for this one. And payments volume was down 10% this quarter. And it was actually flat. Right. Well, let me start with this. It was flat the previous quarter. And now it's down 10%. So that basically indicates that next quarter is going to be substantially worse.
It's going to be worse,
for that segment, which that segment's about, about 40% of their overall business. So
Okay.
That's sort of what to expect going forward. But in terms of what happens with the number of transactions and what happens with international revenue, that I guess will still be up in the air.
Right. Okay. So that's just relating back to that first part of their revenue. So they got three parts of their revenue, and that volume down 10% is that first part.
Exactly. So yeah, and I would imagine that if payments volume is down substantially, the number of transactions is also down substantially. It's not necessarily the case, but that's usually those two move.
You would imagine, yeah.
Yeah, most of the time those two move quite similarly. It's just Visa measures how they charge the banks in two different ways. They add up the total amount, and then they add up the transactions, and then they charge them a little bit for both of those.
Right.
But in terms of their profitability, so their net income came in at $2.4 billion, which was down, and it was down 23% year over year. But the interesting thing is that, and the reason why sort of net income was down more than revenue is because expenses only decreased by 5%. So this is a problem with most businesses is when they see a big drop in revenue, usually they can't drop expenses at the same rate because they have fixed costs. They have costs that they can't eliminate.
Can't avoid. Yeah.
So as a result, expenses were only down 5%, and that's why profit decreased more than revenue.
But they have so many less expenses in total. They're a higher margin business than what we were talking about before with Starbucks.
Yeah, exactly. And the thing is, it's going to take a substantial drop in revenue for them to be unprofitable. And that's kind of the difference between something like Starbucks and Visa. The interesting thing here, I guess, the bottom line in terms of what their profit margin was, even after this quarter, which may even be the worst quarter in their history, their profit margin was still 50%. So that's the insane thing is they see a 17% drop in revenue, and their profit margin is 50%. So
50%, man.
And that's after taxes, after everything.
That's big.
Yeah.
That's really big. That's insane.
Yeah. I mean, particularly for a business of its size, usually when businesses are that big, it's very hard for them to increase their profit margins, but it's just the nature of their business. They have very little fixed costs. They have very little expenses overall. And as a result, they keep most of what they make, which is it's a great business.
Yeah, that's insane.
Yeah. The other thing is in terms of their cash flow, and I was speaking about this in a video I created this week. So their free cash flow came in at $7.8 billion. And then of that $7.8 billion, they used 6.6 to do stock repurchases and $2 billion to pay dividends. So, and this is what they do every single quarter. They basically distribute everything to shareholders. And typically you might think, well, if a business is distributing everything that's left over after the normal operations, how can they grow? Well, they actually don't really need any money any reinvestment to grow. They need very, very little to be spent on capital expenditure because of their really strong networking effects. Because they have such a powerful networking effect, whenever anyone goes to get a new card, whenever a bank issues a new card, it's most likely going to be a Visa or a MasterCard. And that kind of just drives growth organically without them needing to do anything.
It's really unbelievable, that business. I remember when you were telling me about it the first time and you were saying how they basically just give out all of their money. I'm like, yeah, all right, whatever. I'm not interested in companies that do that. And you're like, no, they do that and they still grow at this insane clip. I'm like, wait, what? That teaches you the advantage of having some sort of competitive advantage, having a moat. I mean, that's it. They've got this network effect. They've got this competitive advantage. They've got this moat, and that takes care of their growth.
Yeah,
they don't have to, like normal company has to take heaps and heaps and heaps of their profit and dump it back into growing their business to achieve that growth. Visa just kicks up its feet and says, no worries, our competitive advantage takes care of that. That is just remarkable. It's really something else. It's crazy.
It almost doesn't seem real, or it doesn't make any sense. And the video that I released this week, I was talking about the return on tangible assets, which is one of Warren Buffett's favorite measures.
Yeah.
And typically a company will. So basically how that is driven is it's a relationship between the physical assets that they have to invest in and what cash flows they're producing. and you want to look for companies that are generating a high return on tangible assets and are also reinvesting some of that money to grow those cash flows. But then you have a business like Visa where they increase their cash flows and they barely add any physical assets. Their physical assets stay relatively stable over time. So their efficiency is just going up and up and up as they get larger and as their networking effect increases. So it's a fascinating business.
That's crazy. So there you go, man. Good on you, Visa. All right, shall we move on into Boeing?
Yeah, let's talk about it.
All right, Boeing. Yeah, geez. Here's a company that is just being hit from all angles, unfortunately. So Q2 earnings, a loss of $4.79 per share. They made $11.8 billion in revenue. That's in the second quarter. So analysts were expecting a loss of $2.57 a share and $13 billion in revenue. So analysts got reality wrong in that quarter. Reality was much harsher on Boeing. So it's actually gotten worse for Boeing after Q1. So revenue was $16.9 billion in Q1. Earnings per share was a negative $1.11. So yeah, really, really struggling. If you look at their airplane deliveries, the first half of 2019, okay, they delivered 239 new planes. All right, that's the first half of 2019. First half of 2020, they've delivered 70.
Whoa.
Yeah. In the second quarter, the one that's just gone, they only delivered 20 aircraft. 20. That's it.
Wow.
It's insane. So because they only delivered 20, they've only generated $1.6 billion in revenue from commercial aircraft. So they've essentially got three parts of their business. And the first part is commercial aircraft. And clearly in Q2, just destroyed, absolutely destroyed. And obviously the big problems that they're facing is obviously they had that. It's just so unfortunate for Boeing because they're really getting hit from all angles. Because before the coronavirus, remember, they still had the 737 MAX grounding.
Yeah, there was a number of crashes, right, that were found to be at fault of those aircraft.
Exactly, yeah. I think it was the software package in the aircraft. So I can't quite remember. I don't follow this company super closely. But yeah, they had two deadly crashes on 737 MAX aircraft. So that got grounded and they have to fix it and put it back through its, regulatory testing process and all that. And then, so that was their big new plane and everyone was going, oh yeah, let's order. And then they can't sell these planes because they're grounded. And then we get a viral pandemic. So obviously the thing that's really hard now about this commercial aircraft side of their business is that the pandemic, obviously it stopped all air travel. I mean, demand for flying in the US is down 74% in July compared to last July, which is just insane. But the problem is that this company, Boeing, is selling new aircraft to airliners. And what we're finding is because there's no air travel, the airline companies are not flying. They're getting crushed and they're coming out and they're saying, look, we need to make our airlines smaller for a while. We need to stop the bleeding. So we are not going to do as many flights. We are going to be a smaller aircraft. We're not going to spend as much money. And that's a problem for Boeing because they need to try and sell new commercial aircraft to these aircraft or these airline companies. And I just don't see the airliners turning around to Boeing and saying, hey, we'd like to put in an order for 50 new aircraft for next year.
Yeah, it's kind of like the last thing that would be on their mind at the moment. They're up to their necks in debt and they have no revenue coming in and they're asking for government bailouts in this country and that country. The last thing they're thinking about is buying a fancy new jet. I think if an airline went out and bought a new fleet of aircraft right now, they would get destroyed by the media. What are you doing?
Yeah, exactly. I'm just in my head, I'm imagining just this Boeing sales rep just going door knocking, door to door. Excuse me, Delta, would you like to buy some new aeroplanes? No, sorry. I feel for them because it's just so like I said, they're being hit from every angle. It's just the compounded bad things that are happening. Now, luckily, though, this is the good thing, I suppose, if you can take kind of a silver lining out of all this, is that there are three parts to Boeing's business, and they are kind of being held up by the other two parts. So the second part of their business is their, what's it called, Defense, Space and Security segment. Now, that's still brought in $6.6 billion in revenue for the quarter. So that's actually basically the exact same as Q2 last year. So the high ups at Boeing are going, thank goodness we got into defense, space, and security. So all their, government contracts, military contracts, whatever. Right. Thank goodness for that, because they're still bringing in some revenue. Otherwise, the situation would look much, much, much worse for Boeing. And then they're also getting held up a little bit by their global services revenue, which came in $3.4 billion in the quarter versus $4.5 billion in Q2 2019. So yes, a reduction, but not as severe as what we're seeing out of commercial aircraft. So I don't actually know too much about their global services part of their business, but from just like a quick Google, it seems like it's very much like supply chain management, things like pilot training programs, analytics, that kind of services part of aerospace, I suppose. So yeah, just a really, really tough time for Boeing. Operating cash flow was negative $5.3 billion versus negative $4.3 billion in Q1. So it's getting worse for the time being.
I'd have to imagine they'd have a substantial amount of debt at this point as well.
Boy, oh boy, did you get that right. So it says cash and investments in marketable securities increased to $32.4 billion compared to $15.5 billion at the beginning of the quarter. Okay, that seems good.
Oh, they got some cash in the bank.
They've got some cash in the bank. However, driven by the issuance of, you guessed it, new debt. So debt was $61.4 billion.
What?
Up from hear this, up from $38.9 billion at the beginning of the quarter.
Oh, no.
They've gone from $38.9 billion to $61.4 billion of debt in one quarter.
They've gone mad. They've gone mad.
That's just
That's
insane.
ridiculous. What is that? What kind of increase is that? $22 billion or something?
It's a lot. It's like I don't even know what sort of percentage it is. Maybe like a 40% increase or something.
Imagine the interest payment on $61 billion in debt.
Yeah.
Holy moly. Yeah, that's got to be up near $1 billion in interest payments. Just interest.
It's insane. Yeah, it's insane. I should look at, I don't even know what their cash flows are in healthy environments. I should have looked at that, because that would have been interesting to compare. Like, if you just take their normal conditions, assume they get back to normal conditions, and how long or how much will they be hampered? Like, how much of their profits, their future profits, are just going to be sapped up by repaying this debt?
Yeah, I mean, they're going to be in trouble for a long time, because even when flights come back, I can't imagine airlines buying new jets if they've got a fleet that is suitable.
If it can make do.
Yeah, and it's not as if air travel's just going to go back up to where it was previously. It'll be a slow, progressive movement. And obviously, airlines need to buy, I mean, I don't know much about this, but I presume that over time they need to buy new airlines to replace the old ones. But if a lot of these airlines are planning on downsizing, then the process of buying new jets, new aircraft from Boeing will be substantially slower. Plus, you add this huge debt pile. That's insane. I'd have to look up what are the companies with the most debt in the world, in the US, and Boeing has to be up there now. That's a lot.
It's a lot.
$61 billion. Wow.
Yeah, that's a lot of debt. Anyway. I mean, this is an interesting one. It's one that Phil Town holds in his portfolio. So,
right.
I mean, it seems to kind of conflict with his approach that he teaches.
Yeah, I mean, the debt is just insane. That just puts me off immediately. The problem with a business like Boeing prior to all of this is that it on the surface, it looks like one of those businesses that you could say, well, it doesn't matter if they have more debt because their business is so strong. They have such a good advantage. They're in a duopoly market. They're the strongest company in that duopoly market, and air travel is always going to be a necessity. So it's easy to fall into the trap, I think, of thinking some of those things. At least this is my view. But then if you just invest in companies with a lot of debt, before you know it, something happens that you didn't expect. You can't sort of predict everything that's going to happen. You can't foreshadow what's going to happen. And certainly no one foreshadowed that there would be a complete shutdown of international and a lot of domestic travel. It's real strange for Boeing.
Yeah. But I mean, I guess that's why why part of our, strategy is making sure they've got low debt, making sure that they don't get themselves into this pickle. Just we do that on the off chance that something like this does happen, then we as investors don't get screwed over. I mean, that's why we, if environments economic environments were just going to be awesome forever, then part of our strategy, we wouldn't care about debt. It's just like, as long as they can pay back, like whatever, who cares? Like if the economic climate's going to be great and they're going to keep increasing their revenues and get more customers and whatever, then who cares about debt? But I mean, the reason that we look at it is that, what if? It's about covering your ass in the event of the what ifs. And that's what we're seeing now. A lot of investors are, what was that Buffett quote? The only way when the tide goes out, you can see the investors that are swimming naked or something like that. I can't remember the exact
something
quote.
Like that. Yeah.
Yeah. But it's just like, we want to cover our asses when we're talking about these what ifs. I mean, we don't just want to chance it that everything's going to stay good forever. So this is what we're seeing, cruise lines, airline companies, aircraft manufacturer, blah, blah, blah. The list goes on. A lot of those companies are being found out. But yeah.
Yeah. All right. Should we move into some Q&A?
Yeah, let's do it. Let's finish off. Let's get through a couple of Q&A questions. We've got quite a few, so maybe let's try and get through a few.
Yeah. Maybe we'll do a bit of a speed run through a few of these.
Sure.
I'll give you the first one to you.
All right, sure.
So, hi guys. How do you escape the confirmation bias? How to find reasons to disprove your positive hypothesis about a business?
Yeah, it's super important to do this. The way that I tend to do it is I make my kind of investing hypothesis and I figure out why I would be interested and why I think this company is going to do well. And then I just think about, you can do things like reading through the risks of the business that are in their quarterly reports, their SEC filings or whatever. But I just try and think about why could this company be a bad investment? And, look around. There's a stack of people, while there might be a stack of people that think, Tesla's a great investment, there's going to be a stack of people on the other side of the fence that think it's an absolutely terrible investment. So try and find those people, whether it be, on Twitter or on, I see you've written down here, Seeking Alpha, all those kind of websites, Hot Cop or whatever it is. Try and find people that have the conflicting viewpoint, and then you don't just fight with them, but you really listen to why they think the way they do, why they think negatively about the company that you're really excited about, and then see if you can disprove, like actually with evidence, see if you can disprove their reasoning. Because if you can do that, then that's a really good sign, okay? If you can actually listen to, this is why this investment could go bad, this is why this company sucks, this is why they're going to go under, and you can actually disprove each of those points, then that is a good sign. And you should always try and do that with your investments. I don't know, what do you think?
Yeah, I mean, there's probably not too much I could add to that. Yeah, just trying to flip your contention, your opinion about a business, and actively seeking out information that would oppose your opinion. And I wrote down Seeking Alpha because that's where I go quite a lot to find opposing opinion and analysis on companies that I think are good, to see if there's any arguments that I hadn't considered thoroughly or anything like that. Yeah.
But it is really important. I think that actually probably the key point to take out of this is make sure that you do that. Make sure that you escape your own confirmation bias. Like sit back and say, I am human. There is some level of confirmation bias within me. Recognize that and take the steps to step away from that and actually go in and look for things that go against your investment, because at the end of the day, investing is not a matter of, I really like this or I really like that. It's successful investors, they just focused on getting things right, just understanding whether this investment is good or bad, not just thinking, Facebook, I like Facebook, I use it all the time, I'm going to invest in it and it's going to be great. Actually make sure that you are right that Facebook is going to be the number one business in 10 years or whatever it is, and their cash flows are going to give you a good return and blah, blah, blah. So, yeah. Anyway, all right, let's move on to this next question. Did you guys take any courses to become investors? I know Hamish has mentioned studying finance at uni, but I'm talking outside of uni. I was shocked to see a course for $5,000, but I'm wondering if that's normal. It's kind of sad that it is kind of normal. I mean, that's the world we live in. All these investing gurus, they want to charge you like, what was it? 5,000, what was Phil Towns' one-on-one coaching, like 30 grand a year or something like that?
Oh yeah. And it's not one-on-one coaching with him as well.
It's like you might get an email from him or something.
Yeah. I think, is that normal? I mean, there's courses that kind of range in all different price ranges. And I mean, you have like finance at university that I studied I only did 2 out of 3 years, and it was $25,000 or something like that. So obviously at the high end where you have a lot of resources available to you, you can expect to pay quite a lot. But in terms of my experience, besides uni, I haven't paid for any courses at all. I just read Warren Buffett's books, or his letters to the shareholders that have been put into a number of books, Ben Graham's books, Phil Towns' books. A lot of what is in just the content put out by those people is highly valuable. With that said, I could see value in taking, I don't know if I would spend $5,000, but in taking some kind of accounting or corporate finance course, just to develop a deeper understanding of financial terms and also understanding cash flows. Accounting and corporate finance were two things that I studied as a part of my finance degree at uni, and I probably there's a lot of assumed knowledge, I think, when you go and read annual reports, particularly in understanding accounting. So if you didn't have any background in either of those two things, I could see value in going and learning more about certain financial terms, how to read through a balance sheet and income statement, and learn more about cash flow and how to do discounted cash flows and that sort of thing.
Yeah. Yeah, I just think with these courses, you just got to make sure that you know what you're paying for. That's the main thing. But I mean, you can get so much stuff pretty much for free. Just read Warren Buffett's letters. Yeah, so true.
Yeah. All right. I'll pose this question to you.
Sure.
To get better returns, is it better to invest in lump sums or to stick with dollar cost averaging?
Yeah, this is really interesting. So I guess how do we define each of these? Lump sums, maybe just saving up heaps of money and then just plonking it into the market at once, or is it over time? You're plonking lots of lump sums in over time?
Yeah, I mean, I guess you would maybe let's go by this definition, and then if we're interpreting this question wrong, just let us know. But I would go by dollar cost averaging is, let's say you're coming back every few months and consistently adding, maybe even every month, depending on how much you're investing. Whereas lump sum maybe every couple of years or every year.
Oh, okay, yeah.
I don't know.
So there's like advantages to both. Obviously, dollar cost averaging, you're investing into the market more frequently, and that means that you're going to run into more frequent brokerage costs, for example. So the costs of dollar cost averaging might be a little bit higher. Investing lump sums, you just save it up, and then once you've got a heap of money, then you plonk it in all at once, and then you only have to pay for brokerage once. So there's an advantage right there. However, the reason that dollar cost averaging is so popular is because it's very good at, over time, averaging you out to the market return. And for passive investors that do dollar cost average, usually that's exactly what they're trying to do. They're picking a market tracking investment of some description. They keep contributing to it over time as the price goes up, down, sideways, down, up, down. Then over time, because they're investing quite frequently, they do just average out to the average return, which is what they're trying to do. The problem with investing large sums of money at once is that you're stuck with that specific entry point on that day that you bought the shares, and then you wait for another couple of years and you're stuck with, or you wait for another maybe year or so, then you're stuck with that, whatever the price was on that day in 12 months time. So it's very hard to actually get the average over time because, for instance, you might, invest, say, right now, and let's say the market's really, really high and you plonk heaps of money in, and then it crashes horribly and it stays down for the next 6 months, and then it slowly rises back to its highs before, and then you invest your next sum of money. Well, you've missed out on that time where the market was really cheap. So that's why I'm a big fan of dollar cost averaging. It's just because you go chip away at it over time and that averages you out. There's a bit more risk with investing lump sums because you are stuck with, the price on that day, and that's just it until you come back and invest again.
Yeah, and to give the opposite of what you just explained, you could dump in your lump sum amount for that year, and it could be the best time that year to invest, and you actually outperform the index that year. Yeah, and it's really just the way to think about it, I think, is dollar cost averaging will get you closer to the average. If you're doing lump sum, your long-term return there's just more variation in what that long-term return could be. There's more uncertainty around what your return will be, rather than if you consistently come back regularly and capture more of an average. But obviously you need to balance how often you're investing with how much you're investing because of the brokerage fees. In an ideal world with no brokerage fees, you would be buying the index every single minute of every single day because you would capture the average. That would be the average. But obviously that's not going to get you a good return because you have to pay brokerage in most cases. Destroyed. So you have to do a balance between those two things. What is my brokerage cost? Can I get it below 1%, 0.5%, but still be consistently coming back multiple times over a year?
Yep. Yeah, I completely agree. Nice. All right, let's finish up. Thanks very much for submitting your questions, guys. That was good. And we'll keep going with more earnings reports next week. Next week we've got a lot. Yeah, we've got a lot to do next week. So that is going to be definitely a jam-packed show. We've got Facebook, Google, Apple. You've written down MasterCard. That'll be interesting. Compare it to Visa this week. Ford, geez, that will actually be an interesting one to follow. But yeah, thanks as always, guys. Thanks for listening. We as we say each week, we certainly appreciate the hour or so of your time that you give the podcast each week. We appreciate your support, and we hope that you continue to find it valuable. Thanks, Hamish, for sitting down and giving me an hour of your time and chatting stocks. It's always a good hour each week where we just get to have a yarn about business.
Well, you are paying me, so
that's true. Yeah,
I have to be here.
Yeah, how much do I owe you for this podcast? I've forgotten.
$1,800.
$1,800. Jesus Christ. Well, this podcast can no longer exist, unfortunately.
We're going under.
It's unfortunately it's just going to be me next week. Oh dear. Anyway. All right, let's wrap things up. Thanks, guys, as always, for listening. Submit any questions you want us to answer next week in the YouTube version of the podcast. Otherwise, that'll do us for this week. Thanks for listening, and we'll see you guys next time.
See you guys.